This is session 5 of module 3 of the elective paper Entrepreneurship Development of 4th semester of Mangalore University. In this session, we shall study about costing and break-even analysis. According to the Chartered Institute of Management Accountant, costing is the technique and process of ascertaining costs. It lays down basic principles to be followed for ascertaining the cost of the products, the jobs, processes, and services. The process of costing is very dynamic and keeps on changing from time to time and from industry to industry. The application of techniques helps the accountant and management in deciding how to reduce and control various costs. Cost refers to the amount of resources spent for producing a product or for rendering a service. The resources may be tangible, that is, like material, equipments, transportation, etc., or intangible, wages, salary, rent, electricity charges, etc. The cost may be a fixed amount for a lease period or a duration, for example, rent of the building, or it may be variable with changes, for example, stationery, electricity, petrol, etc. Break-even analysis. It is an economic tool that is used to determine the cost structure of a company or the number of units that need to be sold to cover the cost. Break-even is a circumstance where a company neither makes a profit nor loss but recovers all the money that is spent. The break-even analysis is used to examine the relation between the fixed cost, variable cost, and the revenue. Usually, an organization with a low fixed cost will have a low break-even point of sale. Let us see the components of break-even analysis. First is fixed cost. This is the cost that remains same with an increase or decrease in company's production volume. It is independent of business operations and is payable even without any productive activity. So initially break-even cost will be high. These costs are also known as overhead costs. These costs materialize once the financial activity of a business starts. The fixed prices, which include taxes, salaries, rents, depreciation cost, labor cost, interest, energy, etc. Second is variable cost. The cost directly linked to the unit of production, which fluctuates with the increase or decrease of the production volume. It is called as variable cost. These costs include packaging cost, cost of raw material, fuel, other materials which are required for production. The third component is revenue or the income. The total value of income generated by the sale of the goods and services by a company. It is the revenue that you get in return. Next is contribution. The sales revenue less the variable cost is the contribution margin for a company. Uses of break-even analysis. First is for new business. For a new business venture, a break-even analysis is essential. It guides the management with pricing strategy and is practical about the cost. This analysis also gives an idea if the new business is productive. Second is manufacture new products. If an existing company is going to launch a new product, then they still have to focus on a break-even analysis before starting and see if the product adds necessary expenditure to the company. Next is change in business model. The break-even analysis works even if there is a change in any business model, like shifting from retail business to wholesale business. This analysis will help the company to determine if the selling price of a product needs to be changed. What is break-even point? It is that point in the business cycle when a company's sales value equals the expenses incurred. In accounting terms, it indicates the production level at which the total production income is equal to the total production cost. In the field of investments, when the market price of an asset is equal to the original cost of acquisition, break-even is said to be achieved. It is imperative to understand that a business does not profit in break-even, but it does not incur a loss. Break-even point is that point of output level of the firm where the firm's total revenue TR are equal to the total cost. So TR is equal to total cost. TR is equal to TC. Total revenue is equal to total cost. Assumptions. Break-even analysis is based on some of the assumptions. Let us see. First is total cost can be classified in fixed cost or a variable cost, and total fixed cost remains constant at each level of output. Variable cost per unit remains constant at all level of output, but the total variable costs vary with the level of output. Second is the technique of production and the returns to a factor of production remains constant. Law of constant returns applies to firm's factor of production. In other words, variable cost change at a constant rate. Third is the price of the output of the firm or sales price remains constant. Thus, change in total revenue and total output is at constant ratio. Next is the volume of output of a firm and the volume of sales are identical. Let us see the methods to calculate break-even point. The break-even point can be computed by following. First one is the algebra or mathematical equation method, and the second is graphic method. Algebra or mathematical equation method, and the formula to calculate break-even analysis is break-even point is equal to fixed cost divided by price per cost minus variable cost, that is contribution. Now let us see this example. Company X sells a pen. The company first determined the fixed cost, which include a lease, property tax and salaries. They sum up to rupees 1 lakh. The variable cost linked with manufacturing one pen is rupees 2 per unit. So, the pen is sold at a premium price of rupees 10. So, in this case, to determine break-even point of company X, the premium pen will be break-even point is equal to fixed cost divided by price per cost minus variable cost. The fixed cost was rupees 1 lakh and the contribution is, that is price per pen, that is rupees 12 minus variable cost, so that is rupees 10, which comes to 10,000. Therefore, given the variable cost, fixed cost and selling price of the company, company X would need to sell 10,000 units of pens to break even, that is to have no profit, no loss. Graphical method. The break-even point can also be shown graphically. The break-even point chart shows the relationships between cost, volume, that is the sales quantity, and profit at various levels of output. Fixed cost, variable costs, and sales revenue are shown on y-axis and volume of output on x-axis. The break-even point is that point at which the total cost line and total sales line intersect each other. So this point represents no profit, no loss. So this is the break-even chart. You can see here x-axis and y-axis. So this is the region here and this is the point of intersection. So this is the point which is called as break-even point. So let us see what is break-even point. Now the steps in construction of break-even chart. The following steps are followed. First is sales volume is plotted on x-axis. Sales volume may be expressed in terms of value, that is rupees or units, or as a percentage. Second is cost and revenue are depicted in the y-axis. So fixed cost remains constant irrespective to the sales volume, but variable cost starts from 0, then it goes on increasing as the quantity of production or the sales volume increases. When a parallel line of variable cost drawn from the fixed cost line y-axis, it depicts the total cost line. The sales revenue curve also starts from 0 and 0, x-axis 0, y-axis 0. The point of intersection of sales revenue line and the total cost line depicts the break-even point. The area to the left side of break-even point depicts loss zone as cost curve is at a higher level and sales revenue line is at a lower level. The area to the right hand side of the break-even point is called profit zone as sales revenue line lies at a higher level. The angle formed by the intersection of sales value line and total cost line is known as angle of incidence. Larger the angle, lower is the break-even point and vice versa. So here we can see this is the x-axis where the output is given or the volume is given, and this is the y-axis where the cost or the sales revenue is given in terms of rupees. And we can see this line is called as the fixed cost. Here the output is in the beginning, it is 0, 0 because there is no output, but still the fixed cost comes here. The cost will be 90 at 90 point, maybe it is 1 lakh, then it comes here at 100. So fixed cost is the cost. Initially there is fixed cost but there is no variable cost. So you can see here this is the line, this is the variable cost, this is the fixed cost. So the variable cost starts here and this is the production that takes place, and this is a point below this area, it is the loss zone, and above this area, this is the area where it is the company can earn profits. So this is the point, break-even point. You can see here the production is 100 units, that is in 100,000 units, whatever units are given here, and the price is at 290. So this is the point, and this is called as the angle of incidence. So here we can see this is the fixed cost and this is the total sales revenue from this line. This is the sales revenue, and this is the total cost, and this is the profit portion. This is the profit portion only till here. This much is the profit portion, and this is the margin of safety. Now let us see some of the advantages of break-even analysis. It manages the size of units to be sold. With the help of break-even analysis, the company or the owner comes to know how many units need to be sold to cover the cost. The variable cost and the selling price of an individual product and the total cost are required to evaluate the break-even analysis. Second is budgeting and setting targets. Since the company or the owner knows at which point a company can break even, it is easy for them to fix a goal and set a budget for the firm accordingly. This analysis can also be practiced in establishing a realistic target for a company. Third is to manage the margin of safety. In a financial breakdown, the sales of a company tend to decrease. The break-even analysis helps the company to decide the least number of sales required to make profits. With the margin of safety reports, the management can execute a high business decision. Next is it monitors and controls cost. Company's profit margin can be affected by the fixed and variable cost. Therefore, with break-even analysis, the management can detect if any effects are changing the cost. Next, it helps to design pricing strategy. Break-even point can be affected if there is any change in the pricing of a product. For example, if the selling price is raised, then the quantity of the product to be sold to break even will be reduced. Similarly, if the selling price is reduced, then a company needs to sell extra to break even. Now let us see some of the limitations of break-even analysis. It ignores changes in input prices. Prices of inputs like raw materials, wages are liable to change constantly. Break-even analysis is based on past data. It becomes necessary to adjust this data in the context of changes in the prices of input. However, it is not so done. As a result, the use of break-even analysis becomes limited. Second is it ignores changes in product prices. Break-even chart is prepared on the basis of the current product prices. But in real life, product prices undergo changes regularly. However, in break-even chart, changes in product prices are not included, but it becomes difficult to make the correct estimate of the quantity of sale at different prices. Third is static. Break-even analysis is static so far as it is based on the assumption of constant relationship between cost, quantity of production and sale proceeds. In real life, their relationship is never constant. Next is unrealistic assumption of linear relationship. The assumption of break-even analysis that the relationship between cost and revenue is linear is unrealistic. Their relationship is non-linear in real life. Next is profit is not a function of output only. The assumption that profit is a function of output only is unrealistic. In real life, profit is a function of many other factors like technological changes, efficient management, scale of production, etc. Some more limitations are limitations of accounting data. Break-even analysis depends upon accounting data. It further suffers from all the limitations of this data, ignoring of imputed costs, calculating depreciation in an arbitrary manner. All this restricts the scope of break-even analysis. It is also unsuitable for long-term analysis. It is unsuitable because it has relevance only for short-term analysis. It ignores imperfect competition. It is unsuitable for multi-products. Break-even analysis is suitable for a few products. Simultaneous analysis of several products, several plants, several departments is very complex. This analysis is for not very suitable for multi-products. Break-even analysis is the cheapest and simplest guide for policy determination in the short period, but there are limitations for long term. Thank you.